Is paying off your mortgage in retirement a good idea? Well, it would depend, and it depends on a couple of factors. What we're going to do is talk through some of the advantages and disadvantages today, along with some of the things that you should be considering if you still have a mortgage going into retirement. If you've already paid off your mortgage, maybe this isn't the video for you, but if you've not yet paid off your mortgage and you're considering it, whether it be in a lump sum or paying it down gradually, this might be a video that could help you make a decision and understand what some of the implications are. If you've not yet met, my name is Danny Cieniewicz. I'm a CFP professional from Hyperion Financial. Check out the quiz in the description below if you'd like to get a better idea of if your tax plan is on track for retirement. So let's talk through some of the advantages of paying off your mortgage early. Let's start with what I think is the most obvious one, but it's one that I often think is even understated. It's a psychological benefit that a lot of retirees feel when they know that their home is paid off. This one is actually hard to quantify, and as a matter of fact, I don't know if there is a way to properly quantify it. When you know your home is paid off and you can sleep better at night, the question that you need to answer is how much is that worth to you? Therefore, if you're looking to pay this off for more of a personal gain or something that you're able to accomplish that will help you give you better peace of mind, that's definitely worth something. Now, that's not the only thing to consider, but it's definitely one thing to consider. So being able to pay off your mortgage and own your home definitely can go a long way. On the financial side, I think it should be pretty obvious again, but one of them is also slashing your actual monthly expenses. For most retirees, your monthly expenses are going to be made up of a number of different things that you're going to have to pay on a regular basis. Your mortgage generally is going to be your highest fixed expense. Therefore, being able to pay that off can free up some significant cash flow in retirement from month to month and obviously help you allocate those dollars differently. Depending on how much your actual principal and interest payments are, that could be a significant difference for how much you're actually able to utilize in retirement. So for somebody who has a $2,500 mortgage payment of principal and interest, that would amount to about $30,000 per year. Taking that $30,000 per year and instead applying that elsewhere can lead to a number of different possibilities. Having that paid off and freeing up the cash flow can lead to healthier retirement portfolios along with more enjoyment just in general. Something else that can also be considered is that you are essentially going to be getting a guaranteed return. If you had a 3 or a 4% interest rate on your mortgage, that is no longer going to be the case. Granted, it would be amortized in a certain way, but that 3 to 4% interest rate on your mortgage would be no longer. By being able to pay that off at that point in time, you would then have some additional savings from that amount that you'd be paying. Now, again, for most folks, you may realize too that you pay less interest over time. On your mortgage, the interest is front loaded. So as it's amortized over time, you're making more principal payments than you would be making interest payments. So understand that the amount that you're actually paying and the amount that you would be saving in interest would go down periodically. In our uncertain times where interest rates can still be low and some retirees are still living off of savings accounts which are only paying out 1% or less, it's still a savings that you'd be able to recognize. So it's something that you want to give consideration to. Now, there are also reasons not to pay off your mortgage early. And I think this is, again, where things can vary. The first one is that you also want to make sure that you're protecting your investment portfolio. Now, real estate has gone up in value through the years. It's pretty obvious that we've seen this, and especially since COVID, real estate values have jumped up significantly. So you're not necessarily losing any net worth by paying off your home or by paying off your mortgage early, but you also want to consider the liquidity in which you're able to access some of these funds. Yes, there are ways in which you can access home equity, but it's not quite as simple as it would be from taking distribution from a retirement account or from an investment account or from a savings account for that matter. Making sure that you're liquid and making sure you have a plan to protect your investment account and your retirement accounts is equally as important as making sure that you're able then to pay off debt in retirement. I certainly don't want to get into the game of predicting what's going to happen in the real estate market or what's going to happen in the stock market. It's impossible to fully predict or know what the future will hold. But what we can look at is history and how it's guided us. Being that real estate values have gone up, that's certainly a good thing. But again, the liquidity can become an issue. The issue that can pop up is becoming house rich, but cash poor or asset poor. By making sure that you have a plan for your income, which can help provide consistent cash flow, whether it be from investment accounts, retirement accounts, or even from cash that you may have, that can help provide a more systematic process and a predictable process in which you can actually apply to your retirement. If you take out a significant lump sum from any one of those sources and apply it towards your home, well, you could be in a position where you've now tied up some of those dollars to be earmarked to the home, and they can no longer be used for future income. One thing my team and I really value at Hyperion Financial, especially for retirees, is the power of liquidity. Now, liquidity can come in a number of different sources, but generally, if you have safe assets which are liquid and you can easily get your hands on, that's usually an advantage or something you want to have in retirement. If you instead decide to move all of that money to pay off debt, yes, you can take advantage of some of the things that we talked about earlier, but you're then handicapping yourself if you need future dollars for emergencies that could pop up or for other opportunities that could pop up. So making sure you have a properly thought out plan to how you're going to pay off your home is again, a good idea and in your best interest. Now, there are some that may still be itemizing their deductions, and mortgage interest is still something that, again, could be taking place. So, in theory, you could be losing off on tax benefits if you pay off your home early. But with the recent passage of the Tax Cuts 2.0 from the One Big Beautiful Bill, along with the fact that most retirees are getting into their later stages of paying off their mortgages, and the fact that some of these mortgages are so low as far as their interest rate would be concerned, this may not be as much of a consideration for retirees. However, if you are still itemizing your deductions and utilizing mortgage interest as one of the features, then yes, it may make sense to actually continue to keep your mortgage so long as you have a plan to continue to pay it down. If you're going to be moving dollars from a pre-tax account, from an investment account, or from a savings account to pay off a home, each of those have different implications to them. Let's start with the pre-tax account. If you decide to take out a $100,000 distribution from either a 401k or an IRA, which is considered pre-tax, that's now going to be dollars that are going to hit your tax return this year, and it's going to add to your modified adjusted gross income, and it's going to add to your taxable income. So therefore, it could bump you into a higher tax bracket. It could affect your Medicare premiums, your Social Security taxability. It could also affect things like net investment income tax, things that we've discussed at length in many different videos before. So making sure that you are taking inventory of how you're going to be paying off your home is important too. If you pay from just a standard savings account versus a pre-tax account, that could change the recommendation from a planner based on the factors that are at play. But the other thing is the compound growth that could be taking place. If you take out $100,000 at a market high, that's certainly potentially a better move than doing so at a market low. So making sure that you have a plan from your income, your taxes, and your investments to pay off debt, if that's something that you're looking to do, it's important to make sure that all of those are aligned and that it will not affect any one of those three adversely, just so you can have the peace of mind of paying off a mortgage. Now, again, this is also one of those things where it's different for everybody. And yes, I know if you're watching this, you're probably sick of hearing me and others say it, but the old adage is definitely true that everybody's situation is unique. But what makes your situation unique? Well, let's cover some of those things that you should be giving consideration to. The first one is the actual interest rate in which you have. Many people refinanced their mortgages when COVID really wiped everything out in 2020. So for many retirees, we do see them coming in with interest rates that are below 2% or 3%. If that is the case and your interest rate is rock bottom, that's all the more reason that you may just want to consider holding on to it. It's not costing you as much as it would be if you refinance maybe in the last year or two where your interest rate could be 5, 6, even 7%. That makes a huge difference in terms of how much you're actually paying from month to month. And again, it's interest. It's not principal, which is going back to your net worth. It is interest, which is going to the bank. While there isn't necessarily a rule of thumb if it's under a certain percentage, I think it's pretty obvious. The lower your interest rate, the less of a need there is to immediately pay off your debt. Now, you may be in a situation where you've checked all the boxes and it can still make sense to pay off a 2% mortgage. That's certainly fine. But you want to make sure that you're not doing it to the detriment of any other part of your plan. That if you're going to be paying off your debt, that it is, again, serving a role and a purpose, and it's not affecting other areas of your financial planning. Something else that I often see people do is they instead are so focused on paying off their mortgage that they instead neglect other areas such as their income. Your retirement savings balances do matter, and compound interest is a very real thing. If you take a giant lump sum from a retirement balance, whether that be an investment account or again a pre-tax or a Roth account, those are future dollars that could be earned in the stock market. If you're behind on your retirement savings, whichever that goal is, then maybe it's worth just continuing to keep that mortgage in place. Again, especially if it's a low interest mortgage. If you have competing interests where let's say you have a higher interest mortgage and you're behind on retirement, well, then it's worth an analysis to see which of the two are better, but it could mean delayed retirement for you. In the event that you're not quite sure if you're going to continue to pay off the mortgage or if you're going to continue to save towards retirement, again, make sure that you have a plan in place to understand that there could be a delayed retirement is something that you might want to consider. We do often see retirees who have decreased risk tolerances as they enter retirement as well, and for good reason. We see it often where retirees can say, well, I'm working, I don't mind a massive market correction. When I'm in retirement, a market correction can lead to me sweating quite a bit. And again, it's not unfounded. Having a home that is paid off can give you that peace of mind where I know that I at least own my home in the event that the market crashes. But you also want to make sure that you're not necessarily making a rash move. If the market corrects and goes down significantly, you don't just want to say, I want to pay the home off, so I'm going to take and sell low from my account to do so. It's one of the worst moves that I think you can make. Making sure that you actually understand how you're going to be paying off your home and from what source becomes, I think, one of the more important discussions and can really lead to say whether it's worth it or not to pay off your mortgage. Generally, the market has responded well when it's taken a dip. But if you take a significant chunk out of that, you're not giving the market a chance to recover. And again, this comes back to how you're allocated too. If you're over leveraged in stocks and you sell off some of your stock funds to pay off your mortgage, especially after correction. It's generally speaking not a good move to make. The other things that you also want to look into are the fact that if you don't have an adequate emergency fund, emergencies are still going to pop up in retirement, whether your home is paid off or not. Just because your home is paid off doesn't mean that the water heater isn't going to eventually go or that the tires in your car are going to stay good forever. Having an emergency fund in place and making sure that it's adequately funded should stay as a bedrock foundation in terms of your financial plan. And I think it should even take priority over paying off your mortgage. If you're paying off your mortgage at the behest of your emergency fund, that's something you really want to strongly reconsider. For many retirees that have done it properly, perhaps you don't have other debts. But if you do have other debt, maybe consider paying that off first before you pay off the mortgage. If you have paid everything else off, then yes, the last thing to finally check off is your mortgage, and then being debt free is a real possibility. You should definitely look to pursue something like that, so long as it doesn't affect other areas of your plan. And then I think something else that becomes important is what's your actual future plan in retirement? We see it all the times where some people plan to die in their house. They say, I want to leave this house feet first. I'm not going to leave it and go into a nursing home. I'm certainly not going to downsize or move out of this home. And that's totally fine. If that is the case, all the more reason that you may want to look to pay it off sooner. But if you are planning to relocate or you're planning to downsize, then you're going to get the equity in the home whether you decide to do that anyway. So maybe it's actually worth just continuing to hold on to your cash position. And that way you'll have a better idea of what your future plans may hold. In that case, if you are planning to downsize or you're planning to relocate, perhaps it makes more sense just to hold off paying it off just yet. Knowing that you have the cash on hand that you can pay it off at any given point is not a bad feeling to have. But just making the move and then planning to relocate or downsize, you may have cost yourself some dollars there by looking to make the move and then having to get that equity back at a later date. It's also not a bad idea just to consider a few alternative strategies. The first one that I think you can consider is actually just paying a little bit extra on your mortgage. The more that you're able to put on the principal, obviously it's going to knock down the life of the loan. So by paying a little bit extra, you're still keeping some of that flexibility, but accomplishing your goal, maybe just not today. If you're able to come up with a plan of putting down a little bit more into your mortgage, that's going to allow it to be paid off perhaps a little bit sooner. Again, not at the cost, though, of maybe affecting your emergency fund or some of your retirement savings. The second thing that you can consider is refinancing to a shorter term. By refinancing to a shorter term, again, you give yourself a little bit more leeway and understand that there is more of an end date in mind. You can also potentially save in some of the interest as well, being that shorter terms generally will carry lower interest rates with it. It also, though, does depend on the interest rate environment. If these aren't necessarily what you want to do and you do have a lump sum available, it is absolutely worth considering just paying off the mortgage and being done with it. But again, you want to make sure that it's not being done at the detriment of the rest of your financial plan. If you're not clear what your best move is, then it's probably good to talk to a financial planner to make sure that you are making the right type of move. And while, yes, it's important to make sure that you're doing the right things financially, being able to sleep at night also has a value to it as well. Ultimately, it's up to you to decide. My team and I have Peer and Financial help retirees every day with decisions like this. At the bottom of the description, I'm putting a link to our company as well that you can check it out for yourself to see what it's like to get a free assessment. One of the things I think you want to avoid is making sure that you don't run into a tax nightmare if you decide to do this. And taking too much from a pre-tax account could cost you significantly in taxes over time as well. If instead you look to take out from a Roth account, though, that can change the dynamic entirely. For a better understanding of what you can do with your Roth accounts, check out this video right here to have a better plan for what you can utilize it for and how you can save dollars on taxes in the long term.